welcome to TheoTrade. This is Don Kaufman. January 16th, 2021, doing the TheoTrade weekend update here on a Saturday morning. Good gamma trade gone bad. That is going to be one of the primary discussions, of course, of this weekend's update. The fact that we saw a little bit of sell side activity. Let's get to work. We have a completely packed weekend update for you. A lot of thoughts right now. Let's go into the SPX. And one of the most pivotal things that we saw in this week of trade is simply the fact that, we drove directly to the edge of the expected move. This is something that if you tuned in to the last weekend video, you tuned into Monday video, Wednesday video, we were talking specifically about the high probability of us actually tagging the upper end or lower edge of the expected move. And when I say tag the edge of the expected move, people, I mean it. Literally, within $1 of the line drawn on the screen, that is again the edge of the expected move there. And lo and behold, the SPX only closed down about 27, but the S&Ps, they actually continued to sell off after the cash close and actually drove right down to where the edge of the expected move happened to be. Why this is important? Well, this actually deals a tremendous amount with what we term the gamma trade, and that is the market makers are just simply reacting to some of the retail trades, and the delta starts to proliferate. The delta needs to be hedged. We'll look at that all momentarily here. One of the things I do want to display to you, some sell side activity, but are we getting excited yet about it? Listen, I've had some bearish positions on. To see one day of sell side activity doesn't exactly do it for me, but again, we did hit the lower edge of the expected move. This just undid quite a bit of work inside of the marketplace. What you're looking at on the screen right now, it's a 30-day 1 hour. Again, a 30-day 1 hour. And you can see some of the damage kind of inflicted specifically to the S&Ps. But you look around the marketplace, all right, the NASDAQ's been lackluster. I mean, the NASDAQ, though, it's right back where it was for most of the December timeframe. So a little bit more damage maybe inflicted into the NASDAQ, but it hasn't done much. And the Russell, which has been the little engine that could, the damage inflicted literally only undid the previous day's gains. I'll actually go back to a daily chart for you to see that. 1 day up, 1 day down. What does it give you? Absolutely nothing. But it's a start, and there's some volatility that really kind of kicked up in the session. So let's get to work in discussion of what I kind of call the good gamma trade gone bad. And it's of deep concern. One of the first things that I want to point out before I really start to get into some wild specifics here, which I'm going to do here momentarily, and I'm going to tell you, this is going to get a little deep for a weekend video, so extra coffee, this is the time. All right, option volumes. Option volumes inside of the overall marketplace, they're all pointing to a retail fueled bubble, and it is bubblicious beyond anything I've seen. Again, I spent the better part of 15 years inside of the brokerage world, and I've never seen anything like this in terms of volumes. And when I'm talking about volumes here, let's actually cruise over to a little bit of a PowerPoint that I put together. Just one slide. I promise I'm not going to bore you to death with slides over here, but one of the things I want to point out happen to be some of the option volumes. And if you've never seen this before, this is an OCC report. That's the Option Clearing Corp. Now, I threw together the OCC report from January 14th and the OCC report from January 15th. The reason I put 2 days in here is because January 15th happened to be an expiration. It was a primary expiration, so you expect a little bit of extra volume there. January 14th, though, whatever. It's just another humdrum, end of day OCC report on a Thursday. First thing I wanted to point out, listen, options and commissions, generally speaking, they've been free, and they've been free for quite some time. But the proliferation of the use of options has been it's incredible. There's nothing else to say. Listen, this is January, 2020. That's the end of month average. It's about 25 million, right? Oh, well, on Thursday, we actually saw almost 50 million contracts trade. And, on Friday, we actually saw almost 51 million contracts trade. It is incredible, of which only about 2.1 million are index options. By the way, when I talk about index options, this would be specific to the SPX, right? So that would be really specific to, of course, the SPX here, about 2.2 million contracts. The SPX, VIX is also included in there. But for the most part, what you're actually seeing is retail volume is, for the most part, it's doubled. It's up, 100%. You're like, oh, whatever. Yeah, well, I've been watching these OCC statistics, and I've been watching them for, again, the better part of almost 15 years. And they've been hovering in and around, that 20, 25 million for a long time. In fact, 25 million last year was even a lot. Yeah, maybe 20 million option contracts trade. All of a sudden, we're at 50 million. You got to be kidding me. Okay, it's a retail-fueled derivative bubble. Now, there's some issues with that. And when you start to look at it, first of all, let's go to Apple. Okay, Apple traded over 100 million shares. Yeah, but it also did, 1.7 million option contracts out there. And Apple's only a $127 stock. When you start to look at some of the bigger stocks, stuff like Tesla. Now, Tesla did 1.6 million option contracts, which is only about 60% of norm versus the previous 5 days. But Tesla actually traded almost 40 million shares of stock. Okay, so where am I going with this? I'm going to tell you exactly where I'm going with this. When you actually look at 1.6 million option contracts versus 40 million shares, almost all of that 40 million shares would have been perpetuated by the 1.6 million contracts traded in options. That is actually what we term the gamma trade. I mean, for the most part, and I've explained this kind of incessantly, but I'm going to do it one more time really, really quick. You're a retail trader. Okay, you're a retail trader. You go out, okay, and you buy calls. And when you buy calls, you're producing positive delta, right? That's a bullish trade. When you buy calls, the market maker, and we're going to put the market maker down here, the market maker has to sell you those calls. And when the market maker sells calls, okay, what does it do? It forces them into a negative delta position. They don't want to be negative delta. They don't want to take risks. So what do? They turn around, okay, and they buy stock. They buy stock, and that basically slings off the hedge, right? So that's actually going to be positive delta by buying stock. So what are they trying to do? Balance out their equation. Negative delta plus positive delta equals neutral delta. The more you buy calls, the more the stock is going to go up. Why is the stock going up? Because you're buying calls and forcing them to buy stock, okay? This is actually what we call, all right, it's gamma. Yes, it's delta that's causing the risk, but it's gamma. Gamma is the dynamic that's actually driving the delta to grow. So for the most part, you can kind of call it a gamma squeeze, right? But it's a good gamma trade gone bad. And when I say it's a good gamma trade gone bad, oh, you see, the exact same trade that's actually winding us up eventually will unwind. These market-making firms are sitting on ridiculous portfolios, okay? And if you think about their portfolio is this giant balancing act of negative delta versus positive delta. Yet what happens if the marketplace starts to sell off just a little bit? Well, everything that they did to balance out their equation, to buy stock, they're going to have to sell it, okay, and sell it in wild amounts. You need to seriously start considering, okay, when the gamma trade starts to reverse. And not just because we saw a little bit of sell-side activity. I'll tell you exactly why. One of the first things I noticed, this is Friday, right? This is from Friday. The option statistics, this looks downright scary. In Tesla, okay, why? Yesterday was kind of a rocking day, right? Market sold off a little bit. Why did we only do 60% of the volume? Good question, huh? Why don't you go look over at Apple? Apple only did about 70-80% of its volume. Why? Why is the volume dropping over there? Oh, because people don't necessarily know about puts. You have to understand that you're actually seeing right now retail clients, okay, they got shaken a little bit in 1 day of selling. Seriously, 1 day of selling, they got a little bit shaken out there, and their volumes are off. Their volumes are off huge. It's everywhere you look. All right, I'm looking at Amazon. Look at Facebook. Facebook actually exploded to the upside. Exploded to the upside. It too didn't actually do its volume. So when I say it didn't do its volume, what we're looking at here is specific on Thinkorswim. This is today's option volume. Today's option volume versus the previous 5 trading sessions. All right, that's what that sizzle index and put sizzle happened to mean. I know. I actually built some of the methodology for that on Thinkorswim. So you're actually seeing the volumes even dry up over there, which leads us to believe it doesn't matter if the option volumes dry up. The market-making firms still have a tremendous amount of gamma risk left on, and they would actually have to sell into selling, and that becomes a little bit scary. One of the hottest products in the marketplace this past week was none other than energy. Energy, it dove. I mean, it dove by the tune of almost 4%. Okay, what did its option volumes look like? Half. It's crazy. The sizzle index says it has half the volume, and it had one of the most rocking days of the week, being down. Okay, almost what? Almost 4%. Wait, it gets better out there. Why don't you go take a look at the financials? Some of the financials got smoked. I mean, a few of the financial stocks got absolutely smoked. Their volume doesn't make sense. There is no volume. That's because the retail trade, they only trade when they're bullish, not necessarily when they're bearish. And this could lead us to believe, all right, that what drove the markets higher will eventually unwind. The delta needs hedging. This gamma trade could reverse. It could reverse in very, very short order. That is one of the first things that I wanted to drive home to you because the volatility would absolutely explode in the overall marketplace as the market-making firms would have to sell into selling. I mean, that's the dynamic of the marketplace. Sell into selling. That's what the gamma trade drives you to do. All right. Completely switching gears over here. One of the things I also want to kind of reiterate is we saw some sell-side activity in the overall marketplace, right? So the S&P's come down, whatever. It's 1%. Again, it's nothing. But there's one thing that's really kind of resonated with me, and it's a change in perspective. Okay, in the previous 4 years, we're going to have a change in administration this next week, right? In the previous 4 years, you kind of felt like anything negative happened to the marketplace. Don't worry, they'll just tweet it back up. They would put Secretary, Munchkin, that's Mnuchin out there. Okay, they kick Codlow out there. Yeah, come on, give me some good news. All right, the president himself would actually tweet the marketplace back up. Anything and everything to actually sustain the marketplace. I'm going to tell you right now, the new administration, you are not going to get that. The other thing you really need to think about, okay, this is some sell-side activity on some really strong news. I mean, listen, $1.9 trillion of stimulus and we actually sold off. All the good news is priced in. If you don't believe that all the good news is priced in, I think you should look at the financials, right? And I've been talking about the financials incessantly. And we even talked about the idea of the financials selling off on good news. They did just that. All right, Wells Fargo didn't have good news. Wells Fargo was, they had some issues out there, down almost 8%. Citi, though, okay, ugly. JP Morgan, ugly. Bank of America, they didn't even release their earnings, and it was ugly. It was down like 3%. The point that I'm trying to make over here, though, is I think you need to change your mindset very, very quickly. That this marketplace, what does it have that's going to be positive news? Even over the last couple of years, negative news would even drive the marketplace higher. But right now, you have the Fed. They're not going to do anything. Fed's not doing anything unless it's absolutely, unequivocally a necessity. If the marketplace was crashing, maybe they might pop out and say something. But I'm telling you right now, they're not doing anything. They're even talking about how they're going to unwind this massive amount, of monetary stimulus out there. So, again, where's the positive news cycle going to come from? The negative could actually drive the marketplace down. The positive, okay, it's out there. It is just out there. Change perspective. That's one thing I want to leave you with this coming kind of week. Is that, again, we could have some rough going right now. So not only do we have massive amounts of gamma on, but we also have a change in perspective. And my change in perspective, and again, that's purely an opinion piece, but my change in perspective is I'm not sure where anything positive is coming from when you already have $2 trillion of stimulus following another stimulus bill, following a stimulus bill that happened actually in March, of course, in April of 2020. The Fed is already on the accelerator to the max capacity. They won't do anything unless absolutely unequivocally necessary. It's not like rates are necessarily going down. And then I'm going to also give you this, just a quick take over here. Is this marketplace going to be inflationary or deflationary? There's been a lot of discussions about inflation running hot, running out of control. The more I think about this, the more I actually start to think to myself that it's not inflation we're looking at. It's actually deflation. And this is something that is, again, it's open for interpretation, open for opinion here. But the stimulus bill that just came out, and I think this is also going to impact marketplaces in a big way. Stimulus bill that came out, I think it's absolutely unequivocally inflationary. Okay, so if you take a quick glance at this, the TNX, inflationary, I think you would see interest rates go up. Right. But this was a total like buy the rumor, sell the news. Right. So stimulus bill is actually announced. And of course, the rates kind of retreated. This is the 10-year, which actually hit almost 1.2, was just shy of like 1.2%, reverted all the way back to, about 1.1% on the 10-year. But the reason that I'm bringing this up, this is going to impact markets for the next couple of years. As I said, there's going to be a little bit of a change of perspective. And I think you have a lot of people that are like, no, man, what the Fed is doing is totally and completely what? What is the Fed doing? It's totally and completely what? You're going to tell me inflationary? Really? Because they did that in Japan. And Japan is the greatest monetary petri dish, okay, anywhere in the world. What they did in Japan is they went out there and they just flooded capital into the marketplace just like we're doing now. But Japan even went out there and bought their own ETFs. We haven't gone to that extent yet, but we're close. All right. But you have to actually ask this question because the stimulus bill is wildly inflationary. But they actually kind of alluded to the fact that there's going to be some big changes to the tax code, which is unequivocally deflationary. Actually, if you guys know anything about MMT, modern monetary theory, the way to actually curb some of the inflation, tax the inflation. But then the other questions over here, which are absolutely unequivocally deflationary, would have to be some of the price action inside of gold. Come on, if inflation is coming, how come gold's tanking? Gold is tanking. Say what you will, but on a year-to-date basis, gold's already down 6%, right? So again, you look at this and I'm like, well, that gold's not exactly taken off. And then of course somebody's going to argue, oh, what about Bitcoin? Yeah, that too looks a little bit rough. Maybe they're buying Bitcoin to sell gold, something along those lines. But even Bitcoin took a substantial, 8% hit. That's an outright crash, people. When something actually loses some 8%, that is an outright crash in there. Anyway, I want you guys to be thinking a little bit about this because I'm actually in the deflationary camp right now, and that is in stark contrast to some of my belief quite recently. But so how is that going to impact trade? I'll tell you exactly how it's going to impact trade. Bond markets. So the bond markets look like they're about to sell off into the oblivion. I just don't believe it. I think the bond market is capable of actually staging another surprising rally. Why? Because in the end, I still think that traders are probably going to run into the bonds to some degree to mitigate risk and exposure if the S&Ps really start to sell off. One of the things, and this is where I was going with this, one of the things we haven't seen in a long time, they sold the S&Ps, they bought bonds, they bought volatility, and they bought dollar. Think about this for a second. That dollar, that dollar becomes kind of the new VIX because if the whole world starts to see sell-side activity, where do you want to put your capital? Clearly, they're not running to gold, right? What are they doing? They're running to the U.S. dollar because in the end, even though our dollar might be crap, our crap is probably better than their crap. And that is, for instance, the euro, where are you going to go? The yuan, right? It's not going to happen, right? Everybody's going to rush into the dollar. Watch this dollar very, very carefully. All right, a couple last things over here. The shift to selling premium. So recently I've introduced the TheoTheo portfolio. And the reason the TheoTheo portfolio is so important is I'm selling premium all of a sudden. And you go, how come you're selling premium, man? You've been buying premium a lot. I have, The equity skew demands it right now. If you start looking at things like Tesla, and why I've been selling premium, products like Tesla, the implied volatility skew, and I'm actually going to bring up implied volatility skew. The implied volatility skew and way out of the money options here, there's actually a completely inverted skew. For all intents and purpose, in a lot of products that you look at, whether it's Tesla, whether it's, Facebook, there is more implied volatility the further you go out of the money. And again, look at it. Listen, the implied volatility skew, it just kind of means like there's more risk to the upside than the downside. That begs to be sold. Retail clients are coming in there and they're buying so many call options that they're actually causing the skew to invert. Think about that for a second. So I give it to them. I'll go out there and I'll sell those calls. I will sell those calls all day long. I'll sell the puts too. But in this kind of volatility climate, it's worth the risk. It's a big change, and I've been watching this change really kick in like the last 6 to 8 weeks. It is like you can taste it. All right. That's how much of the implied volatility skew has inverted. So the equity skews are inverting in a lot of these products, which is phenomenal for being able to sell premium. And ironically, it's call premium and or call, some type of call spread. But the index skew is also massive. And what are we looking at there? This, I'm actually talking about the put side of it. So if you look at something like the spiders or the SPX, whatever product does it for you, right? If you look at, first of all, at the spiders, they traded 5.5 million contracts yesterday, and that was actually normal. They're doing 5 million contracts, and that's normal. But when you start looking at the skew in these and open up like 30-day options in here, the out-of-the-money puts are trading for a huge premium over the out-of-the-money calls. So quite ironically, inside of the index products, the puts are the way to go. The puts are actually going for some fairly incredible premiums, and the equity products, the calls are going for some some incredible premiums. And net, if that doesn't do it for you, listen, the VIX now, pretty much since the onset of the coronavirus, has sustained above the 20 region, and it's just providing at this point, an excellent premium selling opportunity is starting to open up. But the irony is that premium selling opportunity, it hasn't really opened up, at least for me, until about the last like 6 to 8 weeks, because these skews are so large. And by the way, if you're unfamiliar with skew, there's even a symbol you can look at called skew. And skew is only calculated at the end of the day, but this is the CBOE skew index. What skew actually measures, really specifically, it measures the out-of-the-money puts versus the out-of-the-money calls in the SPX, the mother of all option products, about 30 days out. So it actually measures implied volatility of the out-of-the-money puts versus the out-of-the-money calls, and the skew is absolutely, it's been massive out there, right? And it is, again, you have to change with the times. And that's one thing, as I was saying, earlier, change perspective, but you also have to change strategy with the times. And there's a shift to selling premium right now because the higher volatility climate, well, that's been around almost a year now. It's the higher volatility climate in combination with the fact that the skews are all over the place. And that, people, is taking the risk of selling premium more reasonable. Last, but definitely not least, okay, SPX. So the SPX, as I started with, tagged the lower edge of the expected move. But there's a big takeaway from here, okay, and that's this. The SPX, okay, in the previous week of trade. Now, the previous week of trade was a full 5 days. And the SPX, right, the SPX expected move was equivalent to about $77. So the previous week, right, the one that we just passed through, we're looking for a $77 move higher, $77 move lower. We got every ounce of it. We literally tagged the expected move on the edge. Here's the interesting thing. This next week of trade, okay, your expected move is actually going to bump to 82.50. You're like, oh, big jump. It is a big jump. Why? Because this is only 4 trading days. This Monday, the marketplace will be closed for Martin Luther King Day, and we're going to have 4 trading days. With 4 trading days, seeing the implied volatility up, things are going to get a lot more interesting. Okay, the volatility is for the most part, the volatility skew is kind of flattened out about this 20% region, but it's something definitely to pay attention to, because what occurred in just one trading session really changed the way we felt about the marketplace. And we're going to see if there's some follow through to this, because again, lower volumes in the options marketplace, lower volumes in stuff like Apple and Microsoft, we're still doing, 7 million, contracts, 50 million contracts, but lower volumes in a number of the products. I smell a little bit of danger on the front. And that, coupled with the fact that we have increased implied volatility, increased movement with 4 trading sessions, again, we're going to come into a week with some serious risk. So keep your helmet on this next week. There is a huge amount of movement possible, plausible. Watch the bond market. A rally in the bonds, almost assuredly, okay, would see some sell-side activity inside of the S&Ps. A rally in the dollar will see some sell-side activity inside of the S&Ps. The big issue, if the S&Ps start to sell off, okay, the market-making firms will sell into that sell-side activity. That's it for this weekend's update. Thanks, everybody, for tuning in. Enjoy the holiday weekend. Bye-bye.